Hi everyone, welcome to today's video. So basically when people want to build their dividend income streams, there are two types of options that they execute. The first and the most common option is that people will buy dividend paying stocks. For example, here is a list of top dividend paying stocks in India that have paid the highest dividend yield last year. So people would usually go and purchase these type of dividend paying stocks. Option 2 is that they would go and invest some of their money in fixed deposits, recurring deposits. They will buy some debt mutual funds. They will buy some government securities. And they will think that, okay, you know what, my job is done. I have built my dividend income streams. Now I can sit and enjoy my life. But here is the massive problem in either of these options. There is a big timing issue. Now, what is the meaning of timing issue? Let me demonstrate that by talking about the example of IOCL, which is India Oil Corporation Limited, which is one of the strongest dividend paying stocks. So last year, IOCL had given a total of roughly 12 rupees of dividend. But a lot of people made money on IOCL and a lot of people lost money on IOCL. So for example, you can see that in the year 2021, IOCL moved from roughly 60 rupees all the way till 90 rupees. And now it is back to roughly 70 rupees. So now let me run the math for you and explain. So the total dividend that people made was roughly 12 rupees. For the ease of computation, I am considering dividend as 12 rupees, which is applicable across any of the price you must have purchased. This is not true. This is just an assumption to illustrate the math. So let's say that you purchase this stock at roughly 65 rupees. Now the stock is trading at roughly 72 rupees. Now, how much gain you have made in terms of stock appreciation? So you have made roughly 7 rupees. And what is the total dividend that got paid to you? So roughly 12 rupees. So plus 19 is the total profit. And under this scenario, you made money. But option B is that many people must have purchased IOCL at 90 rupees. Now the stock is trading at 72 rupees. So the loss is 18 rupees. Yes, you made a dividend of 12, but the net loss remains minus 6 rupees. Now you will say that, okay, you know what, loss, profit, it keeps on happening in the stock market. So what's the big deal? Okay, the big deal is that if you would have purchased IOCL in any of this curve, you would still be sitting at a massive loss. And take a look at since when this stock has been trading at this point. It has been trading from roughly 2017 from this point. So majority of the people investing in IOCL thinking that, you know what, I'll make like crazy amount of dividend money every single year. Well, net you're losing money. So this is one of the key mistakes that people make when they buy dividend paying stocks, that they will just think about that, okay, total dividend itna aa raha hai, so I'm making money. But the issue there is that the stock price itself can go down and it can bring down your gains quite significantly. So on this video, I'm going to help you understand how to properly build a dividend income plan and what is the timing aspect that you need to keep in mind, whether you are investing in FDs, RDs, debt mutual funds or dividend paying stocks. So that is the precise conversation that I'm going to have with you. And if you are making money in the form of dividends that you are getting, then you will have to pay taxes on it. And it is very important to understand how to optimize those taxes. So for that, go and speak with the team at Tax Buddy. They can help you optimize your taxes wonderfully well and can legally help you bring down your tax liability. It is a very important aspect that you need to do. So do check the links in the description box. There is a special offer which you can use in order to avail discount on Tax Buddy services. So let us kickstart our conversation and let us understand two things. One, that what options you can execute, the timing around it. And finally, I will help you understand how you can build a dividend income plan in case you have 10 lakh rupees to invest. So I will help you create a sample plan and talk about two best options where you can go and invest in order to create a dividend income. So the first option in order to create a dividend income is fixed deposit. Now, I don't know whether we can technically categorize fixed deposit at dividend, but the idea behind considering fixed deposit for today's conversation is fairly simple, that it gives you fixed return, non-volatile returns. So therefore you could consider it as a type of a dividend. Nowadays, you might have observed that the FD rates in banks are fairly good and many people are preferring to do fixed deposits. Now, is this the right time to do fixed deposits? Why not? Is there any logical explanation behind it? The best time to do fixed deposit is when the general level of inflation or the target inflation, which RBI is setting, it is lower than the interest rate. Now, what do I mean by that? Let me quickly explain this. But this is the math that you need to keep in mind while doing fixed deposits. Now, if we talk about inflation in India, the target level of inflation is between 4 to 6%. Right now, the inflation is high. It is roughly around 7.5%. But the RBI has decided that, you know what, on the higher side, we need to keep the inflation at roughly 6%. And the best case scenario scenario would be 4%. So the target inflation range becomes 4 to 6%. For people who are new to my channel and are hearing the word inflation for the first time, so inflation indicates the rate at which the prices rise. Now the second thing that you need to keep in mind while investing in FD is the interest rate in the economy. So right now you can see this from this chart that the interest rate in the Indian economy is around 6%. What does this mean? This is the mother of all rates. This will decide your FD rates also. This will decide your home loan rate also, etc., etc. So if you figure a situation where the interest is roughly 6.5%, but the target inflation is between 4 to 6%, it might make sense to do fixed deposit. Therefore, right now it is a decent time to do fixed deposit. Now, why am I saying it? Because going forward in the future, the inflation is going to come down. It will come down to around, let's say, 6%. But the FD rates or fixed deposit rates that you're getting right now at good bank for a period of 2 years is roughly around 7%. Therefore, the equation is that right now the FD returns will beat inflation if you do it for 2 years. And that is the simple goal of FD, to beat inflation. And if the FD is able to beat inflation, then it is a good time to do fixed deposits. So to cut the long story short, the long-term FD rates at good commercial banks are roughly 7%. The inflation in the economy is going to fall to at least 6%. So therefore, right now it makes sense to lock in your FD. Now, please don't start tomorrow that, you know what, FD rates are going to go up further also, etc., etc. All those things can happen. I'm just telling you the timing. I can't help you optimize everything. Right now, it's a very good time to do FD. Going forward, it might become even better. If you're looking to build some positions and create a little bit of emergency fund, there is no problem in terms of doing fixed deposits. Now, you might have a final question in mind that, okay, FD interest rates are high right now, but what is the guarantee that they might not go even higher? Well, they can go a little bit higher in the economy from this point in time, but the forecast suggests that the interest rates are going to come down. So if you do your fixed deposit right now, lock in for a couple of years, then at least for a couple of years, you will be safe. Your option number 2 in terms of building your dividend income is that you go and buy government securities. Now, what exactly are government securities and how do you invest in that? I will talk about that, but let me explain 3-4 debt options here that will clarify the entire issue for you. Because what I generally hear from retail investors is that, you know what, this particular fund is giving like 11% return. It's a bond. I will go and buy it. People will just buy it without understanding the risk. So if you hear my commentary for 2-3 minutes, you will have a very clear viewpoint as to what debt instrument means. So basically there are 2 types of instrument. One is called as equity and one is called as debt. Now, equities are riskier. There is no difference between equity and stock. They are one and the same thing. So when you go on Zerodha and buy your HDFC Bank stock or ICICI Bank stock, what are you buying? You are buying equity. So that is riskier and therefore the expected return is higher out of it. The second type of instrument in which retail investors can put in their money, this is called as debt instrument. Debt means bond. Now, bond is slightly safer. Now, why am I saying that bonds are safer? Very simple, because what happens is that in case some company goes bankrupt. So let's say that HDFC banks get bankrupt because they might have given debt to some big business group. I'll not name them. You guys name them in the comment box. So that group went under, and because of which HDFC Bank went under. So now the liquidation process starts. Liquidation process means that whatever assets HDFC Bank had, maybe they purchased a lot of land, they built offices, all that will be sold off. Who will be paid first? The bond holders are going to get paid first because they have loaned their money to the bank. So let's say that the total debt on HDFC Bank was 5,000 crores. Their assets got liquidated and they were only able to recover 5,000 crores. So this entire money will be paid first to debt holders. Equity holders will not get paid anything. So to cut the long story short, equities are the riskiest and debt instruments are less risky. Now, when it comes to debt, there is different types of debt. For example, the government can issue its debt. When I say government, it could be state government or national government, because they might have to build like roads, highways, this, that. Now you might say that, okay, they charge like taxes also. So what do they do with taxes? I don't know. You guys tell me what they do with taxes. They issue bonds. That's a simple point I'm trying to convey. So the bonds can be issued by the national government also, and they can be issued by the state government also. These are called as government securities or GSEC. There is a type of government security which is very popular. It is called as T-bills. T-bills is a type of a short-term debt. Short-term debt means that it has a maturity of less than 91 days. That once you give your money to the government for 91 days, you are giving it to a solid organization that is less likely to default. Second, the maturity is only 91 days. So 91 days में वो कर क्या लेंगे? ज़्यादा कुछ they can't do. So most likely you are going to get your money back. There is a very high certainty. So GSEC, especially national level T-bills, are the least risky debt assets. Now, if you step up, then you can go and give your money to liquid debt funds also. Now, what are liquid debt funds? So you might have seen that SBI, there is a liquid debt fund. There is a liquid debt fund by UTI. So a lot of mutual fund houses, they ask you that give us your money and we will go and invest this money in liquid debt fund. Now, what type of debt are these mutual fund houses investing your money in? Okay. So first and foremost, they might be investing your money in T-bills. On top of that, they would also be investing your money in corporate debt. For example, I spoke about government debt, then that is the safest. But corporate debt is the debt issued by banks like HDFC Bank or ITC or all these private companies. They also do equity financing, that is they raise money via equity, and they also do debt financing, that is they raise money via debt. So when you go and invest your money in liquid debt funds, then what type of assets is your mutual fund manager purchasing for you? Okay, they are purchasing government debts plus a combination of private debt. So this becomes slightly more risky. What is the meaning of the word liquid? Liquid simply means that these are short-term debts. So they are relatively less risky because the time horizon is less. On the flip side, this third option is very broad. For example, when we talk about investing in debt mutual funds, this can be hyper long-term debt also, 10 years, 15 years debt also, or it can be 90-day debt also. So a liquid debt fund is a type of a debt mutual fund. So with that said, now comes the natural question that, okay, where should you go and invest your money? Because earlier you spoke about the fact that FD kara lo, so that is great. Second is that should I go and invest my money in GSEC, or should I go and invest my money in liquid debt fund, or should I just simply go and give my money to mutual fund managers? So let me quickly speak about that. Now I can create like a 1-hour video on that explaining debt more in detail, but I will give you my verdict that my preference is usually to invest money in T-bills. That is my number one instrument in terms of investing for emergency funds. Why is that the case? Let me explain that point by borrowing the commentary of Mr. Nitin Kamath, and this is the data that he had shared. So he started comparing T-bills, which is a type of a government security, which is one of the most secure forms of debt instruments. He compared T-bills returns with fixed deposit returns, and this is the data. Okay, so just a very small correction. The T-bills can be of 364 days also. So there are different varying durations that you can buy, not necessarily 91 days. So anyways, coming back, that if you are considering FD duration, and this data was around 5-6 months back. So at that point in time, 91 day HDFC FD was giving you 4.5% return. But the T-bill was giving a roughly 6.5% yearly return. On the flip side, if you do a 364 days FD, then you got 5.5%. And here you got roughly 7%. So the difference in return is the first key difference between fixed deposit and T-bills. The T-bills generally give slightly higher returns. This is point one. Point two, are T-bills riskier than fixed deposits? No, they are less risky compared to fixed deposits. Third comes liquidity and ease. FDs are very liquid because you can break an FD at any point in time. So there is no harm in terms of doing FD. It is very easy also for us to do fixed deposit. But investing in T-bills, it is getting easier, and I will show it to you how do I invest in T-bills. But generally the awareness is very low when it comes to ease of investing in T-bills. A related point here is the liquidity point, that if you want to withdraw your money out of T-bills quickly, that becomes a slight challenge because there are liquidity constraints. Liquidity means that you want to sell your T-bills, but you're not able to sell it in the secondary market because there are no buyers of that T-bills. T-bills, there is a secondary market sale issue that happens. So don't invest in T-bills unless you want to hold them to maturity. If you were to ask for my choice that do I prefer in terms of investing in T-bills or do I prefer investing in FDs, I prefer T-bills. Now comes the natural question that, okay, how do I invest in T-bills? So okay, here is a very quick clip of me investing in a T-bill. So all you simply need to do is that you need to go on your Coin by Zerodha account and look at the auctioning date of these different T-bills. And here you can see that I have purchased a T-bill of 364 days maturity. Now below this option, you would have also seen this tab and you would see that, okay, here the yield is even higher. For example, the Bihar government is giving me 7.3% yield. The Goa government is giving me 7.75% yield. Himachal Pradesh government is giving me 7.75%. So should I not give my money to these people? I'm getting like almost 1% increased interest. Well, I personally feel a little bit iffy in terms of giving money to to state governments, because the project for which the state government is borrowing, that can go bankrupt and your money will go down with it. So therefore, if you're looking to make safe money in dividends, it is better to make a little bit of less return, but keep that money safe. So that is the entire point of making dividend income, to keep it as safe as possible. So now comes another option, that should you go and invest your money in liquid debt funds, because the returns usually are higher than FDs. Is that always the case? No, that is not always the case. Especially that is not the case right now. So right now my preference is T-bills followed by FDs followed by debt mutual funds. Why is that the case? Let me quickly explain that by picking the example of Nippon India Liquid Fund, and you can go and check any liquid fund for that matter. And what you will notice is that if you take a look at, let's say, a 3-year return, the returns are only 4.1%. If you take a look at 2-year return, it's again 4%. If you take a 1-year return, it's again 4.73%. I'll say that, okay, this is very weird, that why am I making like less than 5% return? Isse achha to main FD kara loon. Well, the answer lies in something called as inverted yield curve. Now, inverted yield curve is a complicated macro concept which I have taught in some of my earlier videos, but I'll quickly recap that. Inverted yield curve simply means that the return of short-term debt is higher than the return on the long-term debt. Okay, so if you break it apart, the answer is very obvious, that right now it makes less sense to invest from a long-term debt perspective, and it makes a lot more sense to invest in the short-term debt perspective. So in case this concept is complicated, it's not as if that you need to understand the entire yield curve inversion phenomena that is happening. You simply need to pick up this commentary. And this comes from Mr. Sandeep Bagla, who is the CEO of Trust Mutual Funds. And he says that in case interest rates soften, can deliver returns higher than the portfolio yield and vice versa. FD rate of return stays similar throughout the tenure. So right now you can see that the base interest rates are going up, and therefore the debt mutual funds are not performing that well. Now, when the interest rates are cut, then that is the time when debt mutual funds are going to perform better than FDs, and that is when you should shift your FD money into debt mutual fund money. Now, let me very quickly talk about hybrid mutual funds. That should you invest in hybrid mutual funds? Well, to cut the long story short, no. I personally never recommend anyone to invest in hybrid mutual funds, and here is the reason. So you can see that hybrid mutual funds first and foremost have a very high expense ratio. So that is close to 0.81%. Second key problem with hybrid mutual funds. So hybrid mutual fund means that it's a combination of debt and equity. The problem here is that you don't know where the mutual fund manager is going to invest your money. Now look at the performance of this fund, right? For example, in the last 1 year, the mutual fund manager had complete flexibility in terms of putting your money in debt or putting your money in equity. And this is the return that they are generating of 4.5%. So therefore, generally speaking, hybrid mutual funds charge you a lot of money also, and it's not as if that they are able to generate better returns than index fund returns. So generally you should avoid, it's a losing proposition. Okay, so now let me talk about option B, which is that you can directly buy dividend paying stocks. Should you go and buy dividend paying stocks? Okay, so point number one, let's understand it macroeconomically. You should not be buying too many dividend paying stocks right now given the macro circumstances. Okay, what do I mean by macro circumstances? In 2022-2023 period, this entire range, what is going to happen is that the credit is drying up. Now, what do I mean by credit drying up? You might have seen around that a lot of companies are firing employees. Startups are unable to raise money. Why is that happening? That startups are unable to raise money. Adani ji is doing an FPO, follow on public offering. There is a separate video that I'll make on that. Now, why is this happening? That a lot of companies are pushing their IPOs, companies are unable to raise money. Adani ji is doing an FPO, he's not raising money the usual way. Well, the simple answer there is that the credit is drying up. Now, how do dividends usually work? Dividends in simple terms means that if a company is making, let's say, 100 rupees of profit, now that 100 rupees of profit can get added to its stock price. Now, let's say that if ITC is trading at 300 rupees and if it is making 100 rupees of profit per stock, then the stock price should be how much? 300 plus 100. So it will go to 400 rupees. You as a holder of that stock will benefit. On the flip side, the second option that companies execute is that they say that, okay, we will keep our stock price at 300 rupees only. We will not do anything with it. And the 100 rupees of additional money that we are getting, we will give it to our stockholders, whoever is holding our stock. So whether you're holding your ear like this or you're turning your hand and holding it like this, it's one and the same thing. So there is hardly any difference between the two, but there is a very big difference in terms of intent. Think about it this way, that when would a company return your money? They will return your money when they feel that, you know what, there is nothing else that they can do with your money. Now, what does that mean indirectly? Okay, so add all the facts that I'm telling you. Number one, the money is drying up in the economy. company that is making profit, it does not want to invest. Money is extremely valuable right now, but it is saying that, please take your money. I don't know what to do with it. So with that company, it is very clear that it does not know how to accelerate growth. So kindly avoid these type of companies. These type of companies are going to do poorly next year. So therefore, it becomes very important for you to understand the cyclicity associated with credit and how it impacts dividend paying stocks. I had earlier shown you in the video itself talking about IOCL, how it has destroyed shareholders' value. Again, take a look at all these companies. You will see that yes, they have paid great dividends, but the stock price rise has hardly happened. Now you'll say that, okay, no, I would still want to buy dividend paying stocks. So are there any tips that you can suggest? Okay, so there are 2-3 tips that I will give you. Point number 1 is that please trade the cycle. And let me talk about by picking the example of sale. So you can categorically see just by looking at the pricing chart that there is a cycle associated. This is an up cycle, then it goes down, it makes another cycle, then it makes another cycle. Now it is making another cycle. So just buy the stock at its low end of the cycle when it is going down or it has gone down. That is the time you should be buying. You should not be buying this stock when it is giving an up move, right? So that is the first key mistake that people make when they purchase dividend paying stocks, that they buy at whatever price they are getting it. Please don't make that mistake. Number 2, please buy stocks which are good, which have some kind of expansion opportunity left, but are available at a discounted price. A classic case in point would be something like Asian Paints. Don't run after dividend. It does not pay crazy amount of dividend, but it is trading at a low cycle. I will come out with a specific video on a bunch of undervalued stocks that I feel are at a good buying level right now. I have also written a community membership post already, but it takes time for me to release video in case you want faster access to information. So you could consider joining that YouTube member community. So there are specific undervalued stocks that will give you very good returns compared to running after just pure dividend paying stocks. Third and finally, pick up stocks that have a history of giving good dividends, but find them at a right buying levels. For example, take a look at ITC. It has run like anything over the last few months. I had held ITC throughout the last year and I reaped benefit. I sold it at 40-45% profits. Unfortunately, it kept on running after that also, but now it has consolidated and in fact it has started to come down. So whenever you find these type of stocks at a reasonable buying level, it is much better to go after these stocks rather than going after public sector companies like SAIL or highly cyclical businesses like Vedanta, etc. If you get stuck in a bad cycle, you are going to lose crazy amount of money. So now comes the final part, that if I were to invest 10 lakh rupees in terms of creating my dividend income for next year, what would I do? Number 1, I would take 50% position in T-bills plus fixed deposit depending on my comfort level. So this is the first half. Second, I would buy good stocks that are available at a discount, or I would wait for stocks like ITC to come down and then I will buy it because they have a history of paying dividends. But I hope you enjoyed this video. If you did, do press the like button and I will see you soon.